Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we are not going to look at past developments, but focus instead on what we can possibly expect in the RBI's fifth bi-monthly monetary policy review coming up this Wednesday. What makes this crystal gazing particularly challenging is that unlike in the past when you usually had broad consensus amongst market players, this time the field is completely open. At one extreme we have voices, not too many I agree, urging that the RBI should stay put since we don't know what the 800-pound gorilla in the room, the US Fed, is going to do later in the month. At the other extreme we have voices urging not just a cut of 25 basis points but a far more aggressive 50 basis points. And unlike in the past when it was all about trying to guess one man, the governor's mind, post the formation of the Monetary Policy Committee we have the difficult task of reading the minds of 5 men and 1 woman. And that's not going to be easy, which is why I have with me one of the best brains when it comes to RBI watching, Usha Thorat, who as a former Deputy Governor was still not very long ago in the very thick of things at the Reserve Bank of India. Welcome to the show, Usha. So let me start by asking you, Usha, how would you describe the macroeconomic environment since the RBI's fourth bi-monthly monetary policy in early October? Has it changed significantly and structurally, mind you, and we're looking at it from the medium to long-term perspective, because while framing monetary policy responses, one must be able to distinguish between what is really short-term frictional noise that needs to be looked through and what needs to be taken cognizance of.
Yes, Mythili, you're absolutely right. It's both looking at the short-term and the long-term. But I think this is a very unique monetary policy, meeting where, in fact, what we are really seeing is an overwhelming, the current situation is the currency situation and not really the monetary or the liquidity situation. So I think we cannot but dwell upon the aspects of the currency issues and the impact of demonetization. But before that, if we go back to the global scenario, as you rightly said, I think the big issue really is the Fed. And it does seem as if a Fed rate hike is imminent in December. And the other factor, of course, is the OPEC decision to cut back production, which would mean some people say that perhaps it will only prevent it from falling further, and at best it could not go up more than $55. So I would say on the overall global scenario, the outlook for growth is certainly not better than it was in the last monetary policy, except that in US maybe you do have a better outlook. So we can expect some kind of capital outflows to happen, some of which have already happened. Coming back to the domestic scenario, I think growth maybe not as high as people have expected, certainly has come out okay, and there I would say the disquieting feature has really been the manufacturing. So and investment expenditure of course has been very low, and growth has been driven more by consumption expenditure and the government expenditure. So looking at the manufacturing sector and looking also at the credit trends, the manufacturing sector again has not really received any, in fact there's been a contraction in credit. So I would say from all points of view it would appear that there is a growth slowing down in the manufacturing sector, is not looking very positive. But overall the agriculture and the services sector are certainly looking all right, and certainly inflation, particularly food inflation, seems to be very much lower perhaps than it could be expected. But I think all this is overwhelmed by the here and now impact of the demonetization.
So Usha, how should monetary policy respond to the post-demonetization scenario? Should the government and the RBI, in fact the RBI more than the government, apply a temporary salve, or does it have to do something longer term, structural? Does something structural have to be done?
Likely the structural issues are really on this whole business of cashless and trying to reduce the importance of cash in the economy. But given that 12 to 13% of GDP, and that too GDP coming out of the informal sector, is mostly cash driven, and that is a sector which is going to be much more difficult to digitize, I think the structural changes here really are really being focused on that aspect, and the importance given to that aspect is evident by the fact that there has been this big group of chief ministers and others really trying to make a concerted move towards that digitization. But the immediate problem, I think, is more in terms of having sufficient currency which can really be pumped into the sector to prevent the slowdown and the second order impact which happens in the road transport sector, on the trade sector, and the even in the agriculture sector. What would have been turned out to be an excellent year for agriculture, we are not sure actually how it will turn out if the same impasse continues as of now.
As you mentioned the importance of the cash economy in India, the question that arises is that has the RBI been caught napping? Should it not have anticipated the huge influx of deposits into the banking system and been better prepared for the consequences? Instead of which it reacted 3 weeks after 8/11, should it not have ensured adequate MSS bonds? We hear that the RBI has now come up with a much higher limit of 6 lakh crores for MSS bonds. But could this all not have been thought about earlier?
No, Mythili, you're quite right, but I don't even know like how much notice was really, how much notice did the RBI really have? Because on the one side you have the compulsions of secrecy, on the other side you have to have the preparedness, and the preparedness is really in terms of stocking, because it's a huge challenge. After all, imagine the kind of length and breadth of the country, and if you look at the 15.5 billion or 16 billion notes of 500 out there and 1,000 billion notes, 86% of the value of the notes in circulation, and a very significant part, that is the 500 rupees being really a transaction note. I think it really calls for an enormous amount of preparation and logistics management. This is one part. Of course, we did have to expect it to come back in the form of deposits into the banking system, because where else would it go? And by all reports, till Friday, you had 8 lakh odd crores which have come back into the banking system. And there was some news report which yesterday talked about 11 lakhs. I don't know how far that is true. But the fact remains is that this amount has to be neutralized through obviously measures like the cash management bills and the market stabilization bills and bonds. And I agree with you, this probably could have been done earlier, but I'm very glad that today we have this announcement of the 7 lakh crores. And that will obviously ensure that this liquidity doesn't distort the bond markets and the interest rates in the in the government securities markets.
You're right that in terms of remonetization, it is a huge logistical, almost a nightmare. But as far as issuing of MSS is concerned, MSS is not new. It was first issued in 2004. So surely operationally, that did not require much logistics. So I find it very difficult to understand why the RBI took so long. Is it operationally such a big exercise to issue MSS bonds, Usha?
No, I don't think so, but I mean, I really don't know how it works. But clearly, the government has to approve an increase in the limit. And I think it is something that could have been easily done, because after all, I mean, the whole focus of it was to ensure that this entire process went through without a hitch. But I would say, Mythili, maybe the CRR for that short period of time, and now that can be unwound, and MSS can be issued into the market. So I would say really we should really go ahead. I mean, I agree with you that there has been a delayed response, but I think now we should go ahead and see how this is going to span out for liquidity and inflation in the economy, and also the impact on growth.
There are also expectations that because the huge surplus of liquidity and the way bond yields have fallen, the RBI will cut rates. But does a rate cut from the RBI really matter anymore, since the market interest rates have already fallen significantly, and not in response to any signals from the RBI, but in response to liquidity increase?
Mythili, you're absolutely right. In fact, it was a shock when we heard that State Bank had slashed the interest rates by 1.9% on their deposits. I mean, there has been a huge reduction in interest rates, and I'm not very sure whether there is really any need for further interest rate cut, because the transmission happened the minute interest rates touch the reverse repo rates, and this hasn't happened for a long time. So I think everywhere, whether it's government bond yields, whether it's bank deposits rates, and now we have to see the impact on lending rates, which I'm not very sure I've seen any bank actually announce a reduction in lending rates. But I agree with you, and I also feel that what is really important is really giving credit to the small business and traders and in the rural areas and the small loans, because that's where the withdrawal of currency is really pinching, and currency has to be replaced by credit. But when we look at the fact that even this credit at the last mile requires currency, and if there's a shortage of currency, then giving that additional credit is also not going to help. But I think it has to be a combination of pushing forward that digitization as fast as we can, and providing loans and advances and a fair degree of aggressive lending in the small and medium sector, and the small traders and the small transport operators. I think here is where in the informal economy, maybe through NBFCs, maybe through MFIs, but I think there is a desperate need for credit for this segment of the economy, whose main source of liquidity was really the currency.
Since markets seem to set so much store by a cut from the RBI, rate cut from the RBI, does the fact that you've had a CRR hike and the fact of the MSS scuttle any hope for a rate cut at all from the RBI?
No, Mythili, not really, because see, I don't think we should look at CRR hike and market stabilization bills as a tightening measure. It's just that the profusion, I mean, it's unprecedented, 8 lakh crores in such a short period of time. So I don't think there's anything contrary between. If at all, I would say actually the situation is well poised for a cut rather than not having a cut. Because on the one hand, you did have to stabilize that surge in liquidity by doing something to neutralize it. But that doesn't contradict the underlying trend in the economy, which seems to be that manufacturing sector is very sluggish, investment expenditure is not increasing, credit to the manufacturing sector is very poor. So, I mean, one can say that, okay, with all the kind of revival, maybe in terms of infrastructure and agriculture, one would have expected some kind of a growth in the manufacturing sector. But I would say that I don't think it's a contradictory thing.
Okay. Except that the rate cut has effectively happened, number one, and also the FOMC is going to meet just a week after the RBI's own review. So given the fact that the Fed will hike rates, is there not a risk of portfolio flows reversing? So perhaps the RBI should wait and watch and see what action the FOMC takes and then act. Would you think that is a wiser cause, Usha?
I would say yes. On balance of judgment, I would say either way, is it a balance of consideration that the external portfolio outflows, because I think everybody has already factored in the Fed rate hike. So there have been a lot of portfolio outflows. So when the rate hike actually happens, there may be some outflows. But currently, I think we should be more concerned with the domestic situation than the global situation.
Okay, well, I'm afraid on that note, it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Usha Thorat, former Deputy Governor of the Reserve Bank in India, on what the RBI's monetary policy should look like come Wednesday, given the disruption that has occurred in the economy post the demonetization. Usha, monetary policy has been entrusted to the MPC, the Monetary Policy Committee, post the shift to an inflation targeting regime. But does the RBI's somewhat hasty action in raising CRR on Saturday for the deposits mobilized between the 16th of September and 11th of November, and then promptly doing an about turn and conducting a repo operation for 1,000 billion on the subsequent Monday, suggests that monetary policy in a country like India must be seen as a continuous exercise and not a discrete one in which the Monetary Policy Committee meets periodically, in which case at the very least the MPC members should be full-time members, as in the case of Bank of England. Here the question arises, were the MPC members consulted at all, and how many of them are really familiar with the nuances of banking practices?
Mythili, I think here we have to separate the two things. The unprecedented situation arising out of a very sharp increase in bank deposits in a very short period of time, which is really a question of liquidity management without really changing the fundamental monetary policy stance. So and at that point of time, the only tool that the Reserve Bank had was CRR. How blunt and sledgehammer a tool it is the only tool available. And the MSS did require the kind of government approvals. So like I said, I won't look at it as a turnabout. I think it is a question of liquidity management, because after all, if the yields, the way they dramatically fell, that was not very healthy for the market. It was certainly not very orderly. So even after the dramatic fall and the yields backed up, it's certainly a long way from where the 10-year yields were before all this kind of happened. So I do think that the Monetary Policy Committee takes a little bit, it is not something that has to react to some very different, very abnormal kind of a situation. And the Monetary Policy Committee has to look at the overall macroeconomic trends, the global and the domestic, and look at it in a little bit more medium term perspective, because after all, monetary policy, as we always say, has a lagged effect, and therefore it has to be very much more forward looking. So I think it's very relevant that the Monetary Policy Committee, I don't think there's really, it needs to be a full-time committee, but of course a lot of information needs to flow continuously to the Monetary Policy Committee members, updated about all the data that's really RBI itself is seeing.
It's very difficult to separate the short term, the transient, the structural. These are all very difficult to really separate in a macro economy. So I come back to my pet theory that the wisdom of inflation targeting in a country like India is really very questionable. It tends to blind the central bank to other concerns and focus unduly only on liquidity. Would you agree?
In a way, inflation targeting by using only the single instrument of interest rates, I think does not really work, because in India we have to look at the transmission mechanism not only through that single instrument of liquidity, but also through various measures in which the overall liquidity operations, the monetary policy operations itself is conducted. And as you well know, till April this year, the whole approach was one of keeping the market a little bit short of liquidity at a time when actually there was an accommodative stance. It wasn't till the market and the pronouncement and the communication also was that the Reserve Bank would adopt a neutral liquidity policy in its day-to-day liquidity operations, that actually the transmission started working. So I think liquidity is a very, very important factor which determines the way the interest rate transmission works and the interest rate moves. But it's also the overall quantity of money, and I don't think we can lose sight of that, because we all do know that over the last 1 year, currency had really grown out of proportion with the underlying macroeconomic fundamentals, and there seem to be very strange reasons why the currency was moving up the way it was. And currency always means that the money multiplier doesn't really work, and you found, in fact, and that was exactly happening. Although there was a surge in reserve money, the M3 did not really increase. So I would say that these are fairly complicated in a country like India. I agree with you that you cannot just use one instrument of the interest rate and the reverse repo and the repo rates. There have to be it has to be an overall communication also of the stance of liquidity as also the kind of open market operations that we do.
You spoke of the sharp increase in currency and how cash was increasing with the public, etc. But the fact is that however desirable digitization and moving to a digital economy is, the fact is we don't necessarily have a supporting infrastructure. Even in metros, we don't have complete connectivity. You've seen the number of call drops, data connectivity. So how is one able to ensure that we are able to make that shift? So should there not be some more concerted effort from the Reserve Bank of India also to try and make it easier for people to do cashless transactions?
Yes, Mythili, I think there have been a number of initiatives. After all, this UPI is going to be quite a game changer, but it hasn't really fully come into all the banks, the RuPay card. And I think sometimes it takes a crisis to really get one going.
How much do you think the RBI should be concerned about the prospect of dollar outflows in response to falling interest rates in India, even as the US raises its interest rates? We've already seen a substantial outflow from India in the month of November. So should that be a consideration?
I'm sure that is a consideration, Mythili, because after all we are concerned about the kind of what does happen in the overall portfolio outflows and what impact it has on the foreign exchange reserves and on the exchange rate markets. But I think there has been quite a cushion in terms of the kind of reserves that we have, and I think that is something that we would always follow, I suppose, not to make sure there is no undue volatility, and also see that the exchange rate is something that is fairly competitive. So while no doubt we should be concerned about the fact that interest rate differentials could lead to an outflow in dollars, but I would say overall we should be concerned about growth within the country, because growth is what is actually attracting the inflows in the first instance.
Usha, do the events of the past few weeks reinforce the importance of communication, central bank communication? We've seen that the logistics have been very poorly managed in terms of currency flows to the remote areas, remonetization, availability of currency in ATMs, but there's been virtually no official response from the Reserve Bank of India. In fact, there seems to be a fundamental lack of understanding of banking, as seen by their recent circular, where they, and I'll just quote what they say that in order to ensure that the money that is the new money that is being paid out comes back into the system, they say it has been decided on careful consideration to allow withdrawal of deposits made in current legal tender notes on or after November 29th beyond the currency limits. That means if I were to deposit in the new currency notes beyond, then I am allowed to withdraw beyond the current limits. But there is no way of distinguishing what is the money that is deposited. Money is fungible. So why does the RBI come out with these fairly meaningless circulars?
No, this particular one I was also intrigued, because I don't think in my pay-in slip I'm writing whether I'm depositing the old notes or the new notes. I don't know how it can be distinguished.
But
I think the concern was that people started worrying whether if they start depositing money in the bank, whether there would be restrictions on withdrawal, whether the withdrawal limits would apply even to the legal tender currency being deposited in banks. So the communication is really very poor. Even I was completely taken aback when I read it. And I think but more important than these individual circulars, I think it's very important for the RBI to regularly come out, maybe once in 2 days with once in 2 days or once in 3 days with a kind of at least a statement on how much has been deposited and how many new notes have been injected into the system. Give people a feeling of confidence that yes, you are in charge of the situation, and that this is the problems that we are facing. Especially in remote places, you find currency chests being very discriminatory when it comes to distributing currency in the remote branches. So I think it's important for RBI to really make sure that currency is equitably distributed and have some relationship to the kind of demands that has been made in the past, because if you are facing a temporary shortage of 500 rupee notes and 100 rupee notes, then it is necessary for you to ensure that equitable distribution. And on that, I think a regular communication, I think would be very, very helpful in providing confidence to the people.
Absolutely. From a time when there was too much communication with the Reserve Bank of India, we moved to a situation where there is virtually none. But there's another area where I think silence from the Reserve Bank, I don't know whether here perhaps with more justification, is on the issue of what happens in terms of the currency liability that is extinguished for whatever part of the money does not come back to the Reserve Bank of India. What is your understanding of it, Usha? There is a lot of dispute about whether it can be taken over by transfer to government as part of profit or not. What is your understanding, or is it only an accounting entry and which should not really be transferred to government as profit, because it's not really profit?
Mythili, there are a number of views on this. You can have an accountant's view, you can have a policy maker's view. Ultimately, I don't think the RBI's balance sheet like any corporate balance sheet. But let me first come to the point about liquidation. See, under section 26(2), the notification has been issued withdrawing the legal tender nature of the 500 rupee notes and 1000 rupee notes. No last date has been notified for actually putting it across the Reserve Bank's counter, where you expect the Reserve Bank to honor the promise to pay. To my mind, unless that date is notified, the liability continues as far as the RBI's balance sheet is concerned. It is true that the Prime Minister's speech referred to that date, but none of the circulars of RBI or the notification, the Gazette notification issued under section 26(2) gave that date. So only on giving that date will that liability cease. So till then, I think it's a non-issue.
Okay, but I'm afraid we've completely run out of time, Usha, over here, so we'll have to end this discussion. Thank you so much for joining us. We'll have to wait and see till Wednesday to see which way 5 wise men and 1 wise woman decide. But till then, it's going to be a guessing game. Happy guessing to everybody. Thank you so much for joining us in the discussion, Usha. It's always a pleasure to speak to you.
Thank you.
Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.